Hello everybody, good evening. Welcome to JAIIB English Medium channel. I hope all of you are doing fine. Today in this particular session, we will be talking about Indian economy and Indian financial system. Now, as you know that the registration for JAIIB May 2026 is ongoing, and when we talk about the overall scenario, what should be your approach starting from today itself, since we have effectively less than 90 days for the IFS. It should be to have a conceptual clarity regarding all those important units. Along with that, the second important thing is to solve good quality MCQs, and via this particular new series we will be doing both. Fine. So the concepts, first of all, we will be discussing them. After that, in the later part of this particular session, we will be discussing a few MCQs also. Now, what should you be doing while attending this particular session? Be very much participative. Fine, shows your participation. Try to ask n number of doubts, whatever you have, because ultimately, if you are not asking any doubts, or for that matter, even after attending this session, you are having some doubts, let's suppose for the overview of financial markets, then attending this session won't help you. So try to have your doubts addressed in this particular session itself. And when we say that why we are starting off with module D, because the reason is simple. In IE and IFS, most of the questions you will find in the actual examination, they are from module D. And the reason is very much clear. We have 17 units in the module D itself. That is the primary reason why maximum questions are asked from this particular module. But whether you should only focus on module D, no, that is not the right strategy. For that, we have a dedicated session, the right strategy session on YouTube as well. So after this session is over, do watch that particular class so as to have the clarity that how you should approach the IFS subject in the remaining time duration. Now let's switch to the unit number 29. This is the first unit of module D, known as financial markets, and overall it is just an overview. An overview of the financial markets we will be looking into in this particular unit. And what type of questions are asked, that you must know. Mostly they ask the questions based on definition. Fine, all those definitions which are given in this particular chapter, they are automatically important, and the questions more or less are around them only. And one important aspect of unit number 29 is that it will create a linkage. If you understand all the types of financial markets in this particular lecture, or for that matter in this particular unit, you will find the learning very easy. Fine, your learning, the journey of your learning will become very much easy for the upcoming units, because these particular topics will further extend into various units. Fine, these are just topics, subtopics of this unit. But going further, unit number 31, 32, 33, you will find direct reference in a particular unit about all these subtopics. That is why we say that do not ignore unit number 29th. So let's start our discussion with a question that what is a financial market? So simply stated, financial market is just a system. A particular process flow has been maintained, has been initiated, where the money is involved. And why the money is involved? Because ultimately the trade will happen. And why we are trading? In order to have the profit. Now one would say that profitability is just one aspect. Whether we are out for the profitability only, we are looking only for profitability or not, answer is no. We want good capital investment, because we want to develop a nation also via the financial markets. The purpose I'm telling you. When we talk about the corporates, they have different mindset. They want profit plus sustainability via the financial markets. For individuals, again, profitability will be the reason. So the reasons may vary for the various players who are involved in the financial markets, but ultimate goal will be to trade, to borrow or lend. Some people, some entity will borrow from the financial market. Some people, some entity will lend via these financial markets. some will invest in these financial markets, and some will try to protect themselves from the risks involved in the market. Fine. So simply stated, financial markets, it has varied, you can say, portfolio, or for that matter, varied reasons why people trade in these markets. And this system where the money is borrowed, lent, invested, and protected is known as your financial market. What else we have to know initially only? So it connects people, fine. Ultimately, the funda which is involved in the financial markets, it is the interconnectedness of various entities involved. So it connects all those players involved in a particular financial market. So it connects people who have money with people, or the businesses who need money. So an individual might need some amount of money, so they can approach the financial market, or for that matter credit market, directly. Then there will be certain institutions, certain corporates who need money for their own good, for making good amount of profit in the future. They will approach some another institutionalized framework or float certain shares in the market, right? So overall, when we talk about financial markets, the reason to initiate their particular process in the financial market might differ, but all those players have a particular motive via which they will be approaching this market. And that is the reason why we have different types, or for that matter sub markets, in this financial market under the ambit of financial market only. What are those? Starting off with credit market, the simple loans we call them. Then we have money market. The money market, it involves short term, you can say, instruments. Then debt market. When we say debt market, the prime example will be your corporate bonds, or for that matter government securities. Then forex market, the foreign exchange market, more or less the trading, the forex operations. You are sitting in India, but your transactions are going abroad, and various transactions are there. Export transaction is there, remittance is ongoing. It will be covered under which type of financial market? Foreign exchange market. Then we have derivatives market. In order to manage your risk, fine, risk management is the ultimate goal in the derivatives market. The underlying asset is there, you are not taking any kind of risk, you want to take minimum risk, you have the support from the derivatives market. Then we have capital market, long term investment, in long term transactions you want to have, whether it is in the form of lending. For one entity it will be the amount which has been lent, the another entity will be receiving that amount, but for long term. Then we have insurance market. Fine. In insurance, what we do, we say that we want to protect ourselves from the risks which are involved. Two different things. One is risk management, there will be risk in the markets, but derivative market will try to manage that risk. Then we have insurance market. We know that there will be risk, fine, the risk will be there, but we don't want to get involved in that type of risk, not at all. So we want to protect ourselves from that particular risk. That is insurance market, a very thin line of difference, but yes, you must acknowledge this particular difference. Lastly, we will be having the mutual fund market. What is mutual fund market? Everybody knows the mutual funds are being traded, fine. You are having hefty returns on the mutual funds. That is the mutual fund market. This is just an overview. We'll be looking into each and every market now in a bit detail. Starting off with your credit market. So what is the purpose of credit market? Simply to provide loan and credit. Very simple. Purpose of money market, for the short term liquidity, to ensure short term liquidity. Debt market, for the long term fixed income, fine, you want to have the long term fixed income, you can trade in the debt market. But when we say that long term capital formation, a particular country wants, or for that matter there are various entities involved which want to have a long term capital formation, for that you have capital market. And these keywords which are listed in the purpose row, you will have to remember. Why? Because ultimately definition based questions you can solve from these keywords. That is why I have made this particular table of difference. Fine. What is the purpose of forex market? If somebody asks, currency exchange. Fine. Nobody will say na, that you have rupees, the rupee note, 500 rupee note, just give it to one particular trader who is sitting in USA. Fine. You have to exchange that particular currency. Then we have derivatives market, risk hedging. Underlying asset is there. You don't want to have the maximum risk, because everybody knows in financial market the risk is huge. Fine. The risk appetite of derivatives market is also high. But why we are trading? In order to manage our risk. Capital market, again, capital formation will be there. Insurance market, risk protection. Fine. Risk management is there in the derivatives market. But when we talk about insurance market, it is risk protection, complete protection. We don't want any risk. That is why here it is written low risk. Mutual fund market, again, investment pooling. Various investors are pooling their money, and ultimately the profit is being circulated. Fine. So the purpose is very important. You should be having no doubt about any of these purposes. Next comes the time period. See, the time period, there are three domains, or for that matter, three classifications under which we classify the time period. One being the short term, then medium term, and the long term. Out of all these, only one particular market is there where you cannot say for sure that whether the time period will be short, long, or medium. Why? Because it depends on the contract, and that market is derivatives market. In derivatives market, it only depends on the contract. Fine. So very important point which you should note, that in derivatives market, nobody can tell yes that for sure the derivatives market will trade in the long term only, or for that matter short term only. No, it totally depends upon the contract. And what else we have to learn, understand the types of various derivative market, we'll be looking into the further chapters also. For now, for today's session, just go through this particular table. So the time period for credit market, short to long term. In the credit market, you have banks involved, NBFCs involved, and they are doing what? Short term lending. Long term lending, more or less, you will find the financial institutions here. Then we have money market. In money market, the time period is again up to 1 year, because they are for the short term. Fine. Short term liquidity is being ensured via the money market. Like when we say na, that the RBI is providing money to the banks, what is RBI doing there? RBI is trying to maintain the liquidity in the economy via the banks. Fine. So money market, you will find the time period up to 1 year, and the key participants will be RBI, banks, or the financial institutions. When we say debt market is again medium to long term. The time period will be, and in the debt market, who are the key participants? They will be the corporates, the government. Fine. Government is the key participant via the government securities, but corporates also participate via corporate bonds, long term corporate bonds. Forex markets, more or less short and long term time period. You can see that very minimum market operations in the forex market is there, where you will be utilizing the medium term, or for that matter mid term transactions. Mostly they will be either the short term transactions, or for that matter long term operations. Derivatives market, it totally depends on the contract. Capital market, long term. Always remember, capital market is for the capital formation, and in a particular economy, or for that matter in a particular company, or for that matter any corporate entity also, you won't be able to form the capital if you are just going around for short term or long term, or short term or medium term. You have to have the time period as a long term investment. Insurance market, mostly you will find long term only. Fine. Beyond 10 years. Mutual fund market, medium to long term. So the time period is also important. Not only the purpose, but the time period as well. At least you must have an idea. Right? Then who are the key participants in all these markets? Banks and BSCs for the credit market, RBI, banks, the financial institutions for the money market. Debt market, government and the corporates. Forex market, you will have RBI, banks, as well as exporters. Fine, because ultimately the exporters of our country, they require the currency exchange, so they will be participating via the banks. RBI will be regulating it. Derivatives market, traders, the investors will be involved here, and the same investors will be in the capital market also, as well as your mutual fund market. Insurance market, you will find the policy holders for sure, along with the insurers, the companies, fine, who are providing the insurance to the customers. Then we have the instruments. What are the types of instruments? In the insurance market, if I ask you, what will be the type of instrument? You won't be giving FD in the insurance market, na? You will be providing what? Insurance policies. For mutual fund market, the mutual fund units will be given. Capital market, shares will be there. Derivatives market, mostly you will find F and O, right? Futures and options. What is futures and options? We'll be looking into the further chapters about the F and O. But right now you can say that for the speculative trading, we utilize the F and O operations via the derivatives market. And this was mentioned by the finance minister also this time. The reason why we have increased the STT, securities transaction tax, because of speculating trading only, speculative trading in the derivatives market. Forex market, what will be the instrument? The exchange, USD to INR, Euro to INR, all these. Debt market, as we were discussing, long term fixed income. Who is the major player here in our country? Government, via government securities, and the corporates are also there via corporate bonds. Money market, we have studied in the monetary policy chapter also. Treasury bill is there. Then we have the commercial papers. Commercial bills are also there. What is the difference between commercial paper and commercial bill? We'll be looking into that also in a few minutes. But right now, just remember that treasury bill, CP, the call money, all these are money market operations. Lastly, credit market, loans or the credit cards. Credit cards are also under the credit market only. So I hope that till now there is no doubt, right? When you talk about the financial market, you must be very much clear that which market is doing what. Otherwise, what will happen after one or two chapters, unit number 30, 31, 32, you will find that something is missing. We are not able to comprehend with whatever is being discussed. Right? These basic terms you must understand first, only then go to the further chapters. Now comes the risk level. So the risk will depend upon the instruments only. So when you talk about credit market, it has medium risk. Money market is low risk. Fine. Short-term liquidity, no risk at all. The least risky market, as we call it, will be the market where the government securities are being traded. So for the government securities, we say that low risk is there. Why? Because it is being floated by the government. But in the debt market, we have another instrument also, the corporate bonds, because of which the risk can be of medium level. Forex market, high level risk is there, no doubt about that. Derivatives, again, they are already, their inherent nature is that they are highly risky. That is the reason why we are providing the risk management in the derivatives market. So risk level is always high. Capital market is also high risk. When you talk about the insurance market, it is low risk, no risk is involved in fact. Mutual fund market, it is of medium risk. When it market can go up, can go down, everybody knows that. What are the examples now? Credit market, everybody knows that it will be the type of loan, home loan, MSME loans. These are credit market instruments, or for that matter, the examples. Money market, you have the repo, treasury bills. Debt market, the RBI gilt, fine, regulated by the CCIL, the government securities when we talk about. Then we have PSU bonds also here. Forex market, export payments, that is the prime example. For derivatives market, Nifty options. Then capital market, you have the NSC, BSC, the Sensex, the initial public offer IPOs will be there. Insurance market, LIC, we have the health insurance also. Then mutual fund market, we have various types of funds. Index funds are also there. SIPs, the most common one. So these are the examples which we will be learning in detail in the respective chapters, because mutual fund has a different chapter, separate chapter in module D we have for the insurance market. For derivatives, separate chapter is there. For forex also, like that. Who is the regulator? Now comes the question about the regulators. So RBI will be regulating your credit market, your money market, forex also. And when we talk about the debt market, some operations will be directly regulated by the RBI, some will be regulated by SEBI. Fine. So both you can say are the regulators in your debt market. But specifically, SEBI regulates your derivatives market, capital market, and your mutual fund market. And insurance market is regulated by our insurance regulator, that is IRDAI. Right. So mind it when I say this, that this particular table is the most important one when it comes to unit number 29. If you have already studied unit number 29, well and good. But if not, then I would recommend to take a screenshot of the same. Now let's have elaborate discussion about each of them. Starting off with capital market. What do we mean by capital market? Simply stated, we are providing funds, right? We are providing funding via credit. So banks will be providing that. Along with that, you will be finding some non-banking financial institutions also being the players of credit market. Plus, there will be some unorganized sources also who will be providing credit. Unorganized sources, the private money lenders, right? So the major institutional purveyors of credit in India are banks and your non-banking financial institutions. Banks can be commercial banks, cooperative, or the differentiated banks. Non-banking financial institutions, NBFCs, right? What do we mean by purveyors? A very important word for the financial markets. It is just a synonym of sellers, fine? Sellers, or for that matter, a particular entity which is offering something, right? Offering you with the credit. So banks are the institutional purveyors in our country under the credit market. So they are providing you with this facility of credit. So these words also you should remember, purveyors. They can ask you in the question in the actual exam. And if we do not know the exact meaning of such terms, we will get confused, right? So the major institutional purveyors, banks and non-banking financial institutions. But what about non-institutional or the unorganized sources? It will be the private money lenders. Now comes the question that what is the most important aspect of your credit market? It is to define that which particular type of loan, or for that matter type of advances, type of credit you want according to your need. So the important aspect of credit market is its term structure, fine, whether it is short term, medium term, or long term credit. Mostly you will find that short term credit is being provided by your banks and NBFCs. And when we talk about the long term credit, it will be provided by the financial institutions. Right? The financial institutions, they will be providing long term funding as well as the medium term credit as well. So, a very important point to note. Normally, we think that banks also provide long term funding, or for that matter, long term credit. But in the credit market, you won't find much of the bank's participation when it comes to the long term lending. That is why we say medium term and long term credit needs will be fulfilled by the financial institutions. Fine. So this was for the credit market. Now let's move on to the money market, a much more you can say relevant, or for that matter important for our examination. So money market, simply, it is a type of market which ensures liquidity. Fine, liquidity is the keyword here. Ensuring liquidity, or for that matter regulating this liquidity, is the important aspect or the function of your money market. So money markets, they perform crucial role of providing a conduit, a pipeline. Fine, conduit is what? Just a pipeline for equilibrating the short-term demand for and supply of funds. So equating the supply with the demand of funds. The funds has there is a particular demand of funds and there is a particular supply of the funds. What has to be done for ensuring this supply? What has to be done for the demand? All these things will be regulated via the money market because of the inherent nature that it acts as a pipeline of supply and demand, thereby facilitating the conduct of monetary policy. In monetary policy, you must have seen that RBI is doing what? It is just trying to maintain, manage the inflation but ultimately how it is managing via the monetary policy tools, and how the monetary policy tools are working via the regulations, or for that matter regulated operations of money market. While interbank money markets and the central bank lending via the repo operations or discounting, they provide liquidity for the banks. These repo operations, though, we know because we are bankers, we know that yes, liquidity for the banks will be ensured by the RBI via various measures. But private non-bank money market instruments like commercial papers, they provide the liquidity to corporate sector. Fine. So when we talk about the central bank lending via the repo operation, the banks will be having some liquidity. Fine. But when we say that there are certain phenomena via which we ensure the liquidity in the corporate sector, not in the banking sector, in the corporate sector, how you can do that? Via the non-bank money market instrument, primarily through the commercial paper. What is the commercial paper? We will be looking in the next slide. So the money market instruments, you can say call money is there, certificate of deposit, treasury bill, other short-term government securities are there. Then we have the example being repos only. The banks, acceptance, commercial bills, very important, commercial paper, intercorporate funds, all these we will be looking now. So money market has the most prominent instruments. These seven are the most prominent ones. And when we say the meaning, along with that, who will be issuing these particular instruments, that becomes very important for our examination. Commercial papers, the CD, certificate of deposits, we'll be looking into a separate chapter also. Right? Once we are done with the basics, then we will be moving to further chapters where the discussion, elaborate discussion, will be there for the CP as well as your CD. But right now, you should focus on these 5 pointers, which will differentiate between various instruments. So when you talk about the call money, what is the meaning? Simply stated, you need overnight funding. So overnight bank borrowing is being ensured via the call money operation, or for that matter instrument. Certificate of deposit, they are for short term bank deposit, right? They are basically the short term bank deposit only. And when we talk about short term bank deposit, it is not like the call money is for overnight, one day, within one day, or for that matter within a time period of 24 hours, the operation will commence and it will be initiated and it will be done away with. But CD, your certificate of deposit, is having a specific tenure. 7 days, starts with 7 days till 1 year it can go. Treasury bill, again, it is for the government short term borrowing. And when we talk about how the treasury bills operate via various tenures, 91 days, 182 days being the normal ones. Then repo operations, again, we talk about the borrowing. So the collateralized borrowing will be done via these repo operations. You have to have some collateral against which the lending will be done. Commercial papers and commercial bills, a very important point of difference between them is commercial bills are for trade only, and trade related bills we settle via the commercial bills. Commercial paper, there will be corporate borrowing. Fine, the corporates are involved, large corporates are involved here. So corporate short term borrowing, commercial paper, commercial bills for the trade related bills. This difference you must remember. Normally students feel that commercial bills is just the umbrella statement, and ultimately the commercial papers are just a part of commercial bill. It is not like that. Commercial bills specifically for the trade finance, for working capital of the, you can say, long term, for the short term, and your large corporates is your commercial paper. Then we have intercorporate funds. So the short term loan between companies, various companies are there. So short term loans being revolved around the particular companies, fine, various companies, short term loan only for the corporates, fine. The issuer will be the corporate. Intercorporate funds, ICF, more or less it is a confusing one. And when we talk about right now what should be your approach, simply just try to have one important example in your mind, that whenever the corporates require money for the cash management. Fine. Whenever they require funds for managing the cash, then ICF will be there. Otherwise, commercial paper will be there. Simple. Okay. So commercial paper, intercorporate funds, both of them will be issued by the corporates only, large corporates, or for that matter, corporates in case of ICF. And the commercial bills, since trade related bills are there, so the issuer will be the businesses. When we talk about the issuer of other four, banks will be the issuer of call money, certificate of deposit issuer is banks again. And when we talk about government of India will be the issuer of T bill, the treasury bill, but not directly via RBI. It will be commencing the operation. Repo, again banks or your RBI will be involved. So the issuer is also very very important. Corporates, for large corporates or for that matter corporates as whole, we have commercial paper and ICF. Two options are there. For businesses, more or less commercial bills is the only option. Now comes the tenure. Tenure we have just seen: overnight borrowing, call money, 1 day overnight; 7 days to 1 year, certificate of deposit; 91 days, 182 days, you have the treasury bills; repo operations, overnight to few days. Fine, it is not a long duration. Commercial bills up to 180 days, that is the limit which has been decided in trade finance. Commercial papers up to 1 year is the tenure. And intercorporate funds, again short term will be there. Short term, you will find that the risk levels are medium, at least higher than the commercial papers, but more or less both of them have the tenure as short term itself up to 1 year. Next, the risk level. Let's just quickly see them also. So risk level for the call money is very low, very low. Nothing to be worried about because it's just a overnight operation. Certificate of deposit, again low is there. For T bill, it is nil, no risk whatsoever, because who is the issuer? Government of India. No risk is involved. Repo operation, very low. Again low, you can say risk is involved in the commercial bills also. Low to medium in commercial paper. And intercorporate funds has the medium risk. Out of all these, if you have to pinpoint that which of the following has the highest risk, then it will be ICF, because for the cash management you are going through this particular instrument. Right, so medium risk is there. But overall, when we say na, in money market, the risk level is overall very very limited. It is not that high as compared to the derivatives. So the purpose for call money will be to meet the daily liquidity, daily basis liquidity. Short term funding you want, then certificate of deposit is a best option in the money market. For government financing, you have the T bills. Liquidity management under the money market, how you will be able to do that, we have seen it in module B also. So repo operations will be there. Commercial bills for trade financing, simple. For trade financing, we have only one option in the money market, that is your commercial bill. For working capital of your large corporates, you can go with the commercial papers. And intercorporate funds, directly the purpose lies in the cash management, which makes it a bit risky as compared to the other instruments of money market. Fine. So again, these tables are very important, like this one in the money market and this the overall financial market. Now let's move on to the next type, that is debt market. What is debt market? So simply stated, you are trying to have some funding or for that matter some investment whatsoever the purpose is, via the government securities. So mostly you will find government securities being traded in the debt market. So the debt market largely comprises of government securities and to a smaller extent your corporate bonds. So corporate bonds will be traded by the corporates, fine, big corporates you can say. So the government securities, what do we mean by that? The definition is very, very important. Whenever we say that financial market chapter is tricky, it is not that tricky if you know the verbatim definition. Government securities, everybody knows that yes, government will be floating some securities via RBI and the people will be buying them or for that matter selling them according to the need, according to the liquidity which is prevailing in the economy. But what is the definition of government security? So government security is a tradable instrument issued by the central government or the state government. Simple. Just a term has been added, that is tradable instrument. You can use it in either form. Long-term securities are also issued by the state government, right? So when we talk about government securities, normally you will find that the state governments do not indulge in the direct security dealing, because the central government is doing it via RBI, and the state governments, they have a separate term altogether for their long-term securities, whatever they are floating, known as state development loans, the SDLs. In your RBI chapter only, the monetary policy chapter, you must have read that there is a particular term utilized for the lending which RBI is doing to the state government. Fine. What is the name of that particular term? Do let me know in the comment section. Fine. Next, we have the companies who raise the funds for a longer period, let's suppose 5 to 10 years, through the issue of typical long-term debt instruments. That particular instrument is your corporate bond. So the companies, they want to raise funds not for short term but for longer duration, let's suppose 5 to 10 years. How they can do it? Via these corporate bonds, and these corporate bonds are part of your debt market only. Fine. Next is forex, the foreign exchange market. What is the name of that particular process? Ways and dash. Do let me know in the comment section. Fine. Okay, you have studied it in the FRBM Act, I think. Okay, next let's move on to the forex market, the foreign exchange market, where you will find a good amount of questions based on the future chapters. Fine. There are various chapters which are directly related to your forex market. So from those chapters, good number of questions are regularly asked by the IIBF. So what is forex market, or for that matter, who all are involved, who are the players in this particular market? Forex market, for your exchange, fine, the currency exchange is happening, but who is doing it, or for that matter, who are the players here? We have the banks, known as authorized dealers. We have the customers, mostly the exporters, you can say, and your regulator, that is RBI. So when we say that forex market, it seems liberal to us, right? You can exchange the money freely now. But whether it was the norm starting from 1950 only, no. Till 1977, this was not the normal thing. Regulation were too high, and the forex market was not open for all. But in the year 1978, the banks were permitted by the RBI to take trading positions. So foreign exchange trading started off in 1978, but still there was some inhibition regarding the trading which is happening in the foreign exchange market. So the push was provided in the liberalization era. The economic reforms, or for that matter, LPG reforms, liberalization, privatization, globalization of 1991, whereby India became practically convertible on current account. What is the meaning of this term? Very, very important term. When we say that you can directly exchange the currency of your nation with the listed currencies abroad, that is simply the meaning of convertibility. Fine. The convertibility of currency can happen. Now, will be it will be at your prerogative whether you want to exchange the currency for the day-to-day transaction, daily basis transaction, or for that matter, long-term transaction. For that, we have two terms. Day-to-day transaction, the current account will be involved. And for long-term transaction, capital account is involved. Fine. So convertibility on current account, now it is freely there. Partial convertibility is there in the capital account right now in the India. So people and businesses in India can freely buy, sell the foreign currency for normal trade and services transaction. That is the norm right now in our nation. But it was not the same in your 1980s, or for that matter 1978 also, it was not there. So when we talk about the expanse, the turnover, since we are saying that we have improved from a particular mark of 1978, whether the same is being replicated by the volume of forex market, the answer is yes. It has led to increase in the turnover in our forex market, and it has ultimately risen to US dollar 60 billion daily. Fine, that is the number. Earlier it was in 2000, the number was only 6 billion US dollar. Now it has increased to 60 billion US dollar, which is a jump of 10x, a quantum leap we can say, for the forex market operations in our country. Fine. So I hope that you will revise all these aspects which we have studied today. Fine. The meaning of current account, meaning of capital account, the derivatives market, other types of financial markets, everything we will be covering in our paid sessions. For now, today, what you should do, try to answer this question. We have covered the institutional purveyors, fine, the credit market. For your reference, let me just tell you, try to answer the question based on that. Any kind of doubt you have right now, just feel free to ask me. Okay, try to solve this question. See, solving question is very important. Our sessions will make much more sense if you start solving questions. Okay, so the question is, which of the following statements is are correct regarding the major institutional purveyors of credit in India? So what do we mean by this term institutional purveyors? We have just seen in this particular session, institutional purveyors are what? They are just the operators, fine, primarily the sellers or providers of your credit in India. So the statements, we have four statements here. Major institutional purveyors of credit in India are banks, yes, the commercial banks, cooperative banks, differentiated banks, all these types of banks are there providing the credit, and your non-banking financial institutions, that is NBFCs. True. The first statement is correct. Then we have non-institutional or unorganized sources of credit include money lenders, indigenous bankers, sellers for trade credit. Again, this is right. We have seen that unorganized sources primarily include your private money lenders. Then important aspect of the credit market structure is the terms. We have short-term credit, long-term credit. Also the medium-term credit is there. So third is also right. Lastly, we have the banks and NBFCs predominantly cater to the short-term needs. This is true. Banks and NBFCs for the short term. And what about the medium and long term? We have the financial institutions. So all the four will be the right answer. Correct answer will be option C. Yes, C is the right answer here. Okay. Any doubt in this? Fine. Next question. Now let's try to solve one-liner question, one single line question as we call it, or for that matter, 0.5 marker question, which we will see in the examination. So in this particular session, you will find question uh, one, which was of 2 marks, you can say. This is 0.5 marker. Next question will be of 1 mark. What are the long-term securities issued specifically by the state governments called? So definition based question, special terms based questions you can expect in the examination. So just now we have seen that long term securities issued by the state governments, they are known as state development loans or the SDL. C is the right answer here, right? Then next question, which statement regarding corporate bonds is true? So if you have understood the difference between government securities and the corporate bonds, then you can easily answer this particular question. So corporate bonds are issued by central government. No, that is not correct. They are short-term instruments, usually maturing in less than 1 year. Again, long-term instruments. The corporate bonds are for what, 5 to 10 years. They are instruments used by companies to raise funds for longer period. Yes, such as 5 to 10 years. Again, this is the right answer. Option C will be the correct answer here. Okay. So yes, this was it for today's session. I hope that you have learned something new today. If you have any kind of doubt, feel free to ask me in the comment section. Okay. Now comes the part where everybody is curious about the approach which we should follow. Since the JAB exam dates are out, now the only thing which will matter is how you approach this particular exam. Whether you feel that okay, now the time is not optimum for me to crack this examination. Let's see for the November exam, November cycle, or for that matter, you want to have a structured way to approach this exam and clear it in May 2026 only. And if you are in the second category, if you are having that mindset that yes, come whatsoever, I will crack this exam in May 2026 only, then we are here to help you out. You will be having the comprehensive coverage of all the four subjects of JAB examination in our JAB Mahapack 2.0, where right now huge discounts are ongoing, along with 3x validity you can get. And when we talk about the queries, if you have any kind of doubt related to this particular Mahapack, you can call us on 0981 981 9247. And for best discounts, you can apply the coupon code Y1003. Okay, so see you guys in the next session.